The number one rule is to make sure you have equity in the deal. So, okay, let's say I was doing a flip. So I'm going to try to buy that flip at 70% of its finished value, 60 to 70%, and then have to spend no more than 10%. So I'm looking for a 20 to 30% margin in everything I buy. And when you do that, you've got to overestimate expenses, overestimate costs, and then hopefully you build enough of a cushion that even if the market turns against you, you still win. I have another rule, which is cut your losses and ride your winners. And most people follow the opposite rule. So if they get into a flip and it gets too expensive, they try to hold their price too high, and then it doesn't sell. And if the market does shift, like you talked about, and it starts moving against you, then all of a sudden you're riding the market down. You're right behind where it should be. So if I have a house that isn't selling, I just cut the price. I've got a window of time. I'll watch it. If we haven't had any success, we'll cut the price. And the reason is I'm trying to not hold on to losers. If I've got a bad deal that I've overinvested in, I want to lose 10,000, not hold on and lose 30,000, if that makes sense. And I think most people do the opposite. They just try to hold on too long. And then ride your winners means when things are going really well for you, like if I've got a great asset that's going up like 3-4% a year, some people would say, oh, I'm going to take that money off the table. But it's like all my assets in Austin, Texas, I'm keeping them. And they're getting to where the rent doesn't justify the return on equity. But if you factor in that Austin's going up 5-6% a year, and I'm borrowing money from the bank, so I'm 50%, 60% levered, that 5% is now plus 50%, so it's 7.5% plus my cash flow. So all of a sudden I have an asset earning 10%, even though a cash-on-cash basis may only be 3%. And that's an example of riding the winners. Because if you look at San Francisco, it went up from 1970 till today with a few blips, a few small blips. I believe Austin has that potential as well, where it could go up from now for the next, till 2040, just because of the number of people that are moving here.
Is there an indicator? You brought up people moving in, which is what I was going to ask you next. Is there an indicator that outside of that people should follow as to which states to kind of look at as potentially the right places to be?
Well, there are two plays. There's cash on cash, and then there's appreciation. Cash on cash is a much safer play, PJ. So cash on cash would be, and I do a lot of this and I love it. I buy in secondary markets outside of big cities where people want to rent a lot. I buy stuff for like $80,000, maybe 70. I put 10 into it, so I'm in it for 80. The day I'm finished, it's worth 100, and I can rent it out for 1,000 a month or 900 a month. And I keep those all day long. I get a 70% mortgage on them, maybe 60%. One of my other rules, PJ, is I believe in having equity in every deal. I don't believe in 100% leverage. I never did, never will. The only exception to that might be if I get a screaming deal, so I'm in it for 50% of the value of the house, but I'm always wanting equity in the house. And here's why. If the market does turn, it usually turns aggressively and quickly against you. And usually you could expect a correction of, say, 10 to 15%, maybe 20. And what I do in those cases is I cut my price immediately to break even and get out, unless I'm in it for the long term and want to hold it for the long term. Because I'm willing, like I said, I cut my losses and I ride my winners. And if you have no equity, if you have 100% financing, you got a $100,000 house and you owe 100 and it turns against you, you can't sell. If you got 10 of those, that's 20 grand a house. Suddenly you're minus 200. Not only can you not take the hit, most people can't take the hit, but psychologically, most people can't deal with that. So they just hold on. And what happens sadly is, in a downturn, it's usually 2 to 3 years down, and you might go down, 20, 30%. Now all of a sudden you have 10 houses that are down 30 grand a piece, you're minus 300. And if rents are going bad as well, you may not be able to hold on. So I always play the long game, and the long game means I have enough equity to get out if I need to. And the second thing is I only keep real estate that has a positive cash flow. And when I say positive, I build in for repairs, I build in for vacancy. I'm overestimating my expenses. So if I project to make $100 a month on a $100,000 house, I'm probably closer to making 150 to 175. Because if you have positive cash flow and the market turns against you, you can last forever. And I have friends who lasted forever, who in 2009, their net worth might have even been negative because they owed slightly more than all their real estate was worth, but they hung on. Rents were actually going up. And today they're worth more than they've ever been before because the real estate's gone up way more than it was before, and they held it all, and they've still got that positive rent. So positive cash flow, making sure you have equity in every deal, not over leveraging, not leveraging to the hilt. Those are some of my rules. You just got to be really prudent and smart. Real estate's a an incredible business. But if you get carried away with yourself, it can blow you up. And my viewpoint is I'm trying to build an armada of ships, and I'm trying not to let one ship that sinks take me down with it. And so I've always got a margin of safety built in. And that's something, I learned from Warren Buffett. I mean, he talks about having a margin of safety in every business he buys. And I just do the same thing in residential real estate.
From your perspective, like when you anticipate either a correction or a crash, do you look at getting out early, or do you look at your exposure? Like, meaning, like, some people would look at it and say, hey, I can get out and get back in, probably lower when the correction happens. There's going to be better deals on the market. Or do you kind of say these deals are still safe, screw it, like it's good enough, keep them?
Yeah, it goes to the positive cash flow or not. Like if I'm in the middle of a flip, I'll cut prices, get out if it's a flip, because a flip's designed to make a big chunk of cash, which you can then use to buy and hold. But if my real estate, like most of it does today, positive cash flows, I'll hold on to it. I have, like I said, 97 or so rental properties. I could have flipped them in 2014 and made an extra $1 million. But they're kind of my safety net. Like I've got that. It's generating about 400,000 a year positive cash flow. It's got a couple points of appreciation. I don't have it highly levered. My leverage is about 30%. But no, I'm not interested in churn too much. I think I always tell people that want to build wealth, you've got to build assets. There's not a single guy on the Forbes 400 list, billionaires, that doesn't have assets. The reason you get on the list is because you have $1 billion in assets. So if you constantly churn and flip and you're constantly going for cash flow, you're not really building any assets. And the other thing is you want tax advantaged assets. Well, the cool thing about being into a house for 20% below market is you never paid taxes on that 20%. And if it appreciates 10%, now you're in up 30%. So let's say you have, again, those 10 houses and you got 30% unrealized gain in every one of them. That's 300 grand you never paid taxes on. Tax rates are about 40%. So you're up $120,000 on 300. If you compound that over a lifetime, you can build a massive amount of net worth. And the cool thing about it too is you can go to the bank and get a little extra loan, and you can find community banks that will loan you money on 20 properties. And you can use the bank line of credit to borrow money to invest in assets without ever still paying that capital gain or that total tax return bill. And if you're a short-term flip, it's full income tax. But if you're long-term, it's just long-term capital gains. But I'm trying to never pay those taxes. So I'm trying to build a herd of assets that I can hold for a lifetime. And I analyze them individually. And if one of them, for instance, the guy, people are stealing the copper or it keeps having water, like a lot of issues, we call it culling the herd, right? So we just take the sick properties, we shoot them in the head, we get them out of our assets. We sell them, we take our gain. But ultimately, I'm trying to build a large portfolio of assets that serve me for a lifetime, that are easy to manage, that I can hire people and build wealth.